10, 9. Call to order the meeting of the Longview Firemen's Relief and Retirement Fund. We will take note of members present. We do have one guest present, Garrett Hanlon with the Longview Fire Department in the crowd. Any citizens' comments? That would be you? No, sir? All right. If not, I think we can move forward to item 2, presentation of third quarter pension performance with Will Harrell and Charles Smith.
Good morning, everyone.
Happy birthday.
Thank you very much. I appreciate that. They're clicking right by. Let's start with the Q3 2024 market commentary. Everything we'll discuss today, most of it will be as of September 30. We do have an update as well, and also an update on the performance of the pension obligation bond money as well. So after gaining 15% for the first half of 24, the S&P 500 ended the third quarter up 5.9%, keeping the index firmly in bull market territory. And for the year, the S&P 500 is up a little over 24%. Since 1960, the index's average annual performance during an election year has been positive 13 out of 16 times. I think it's pretty safe to say that this year will be no different. As of the end of the quarter, total return of S&P was up 36% for the trailing one-year period, 12% per year for the last 3 years. And of course, that includes 2022 down 18.55% and 15.98% per year for the last 5 years. So that number includes not only 2022, but also the first quarter of 2020 during the pandemic. Small cap stocks were up just 1.73% in the first half of the year, but have since rallied up 11% year to date as of the end of the quarter. And right now, small caps are up about 15% for the year on expected policy changes in Washington, including lower interest rates. After finishing 23 up 5.5%, the bond index finished Q3 up 5.2%. However, it has not rallied. It rallied a little bit when I wrote this, but it has since sold off a bit. Even after the Fed lowered interest rates 75 basis points, we've seen that bond index come down a bit and watched interest rates rise. And it has to do with the bond market's perception of not only our fiscal policy, but where interest rates might go in the near-term future. The September inflation data came in at 2.4%, down from 3.5% in May. However, we also just got the PPI, the producer price index, and I believe without energy or food, it was up about 3.3%. So it's inflation, and that's another reason why you've seen the bond market not react more favorably to lower interest rates on the Fed side, is because inflation seems to still be pretty sticky. And then the yield on the 10-year Treasury note ended September at 3.78, rose to 4.1, and actually went all the way up to 4.5% recently, just after the election, and is currently 4.36%. So it's drifted lower a little bit. But again, the bond market wasn't nearly as quick to respond to the lower interest rates as some thought it would. 23 was the first year on record since 1962 that the yield on the 3-month Treasury bill was greater than the yield on the 10-year Treasury note for an entire calendar year. The yield curve has begun to normalize. In fact, Charles pointed out just yesterday that we're talking some flattening, but not really normalization, which is a good thing. Real gross domestic product grew by 3% in the second quarter of 24. And as of October 1st, the estimate for Q3 is 2.5%. Hard landing is really not off the table. And what anyone means by a hard landing is really a more economic recession from having interest rates rise 450 basis points or 4.5% in one calendar year in 2022. And that long-term average is 3.19% for GDP. Unemployment rate fell slightly to 4.1% in September, down from 4.2% in August. But again, the labor market is still struggling a bit. And you can also see that from the bond market's reaction. Clients fully invested, diversified, and rebalanced diligently. This portfolio, your portfolio, will be rebalanced here in about 3 weeks, maybe 4, back to sort of a zero tolerance. So each and every asset has a target weight, and every asset will be rebalanced to that target weight as they are twice a year in the middle of June and the end of the middle of December. So S&P was up 5.9% for the quarter, up 36% for the trailing year. The bond index was up 5% for the quarter, up 11.5% for the trailing year. International stocks were up 7.3% for the quarter, up 25% for the trailing year. Emerging markets were up 8.88% for the quarter and up 26% for the trailing year. And then oil closed the quarter at $68 a barrel. And you've also seen oil drifting lower a bit. So I think we're about mid 60s right now for oil, $67 a barrel, which again is not because we're producing more necessarily. You're seeing lower economic growth and demand has really fallen off. I'm sorry? $69 a barrel at the moment. Thank you, Charles. And that's down obviously from the end of 23 when it was 71 bucks a barrel. Let me jump to your report. All right. And I don't know what I would do without your media technician, Scott Shelhorst. I'd like to personally thank him on the air this morning for teaching me things about my laptop, which I did not know. So we're jumping right into your report as of September 30. This is your balance sheet as of September 30. The total pension fund was right at $102,333,558.82. At that moment, we had about $1.8 million in cash equivalents. And 62%, 63% was in equity funds, 2.4% in hedge funds, 1.2% in alternatives, and the remainder in cash and bonds. This is a graphic representation of the prior page. I would just comment that it is a highly diversified portfolio. There are no sector bets or concentrations of any kind amongst managers. Asset allocation by asset class, 44% domestic equity, 9% internationals, 5% real estate, which includes private and public, 5% emerging markets, 31% fixed income, and the 4% alternatives, which includes the hedge funds. This is a unit value schedule going back to 2011, 2015 through 2018. The end of 2018, you'll see this on recession fears, which kind of wiped out the year for 2018 down to a negative 3%. 2019, you're up nearly 19%. 2020, there's your pandemic quarter down 13.9%, but we squeezed out 11.5% for the year, 11% in 21, negative 14% in 22. That's what I was mentioning earlier when interest rates were raised 4.5%. This is also, fortunately, when the pension obligation bond was issued, financed, and invested. So you see this infusion. It was actually closer to $46 million, but that 44.5 is net of the outflows that quarter as well. And just as an update on that pension obligation bond money, it was all of it. We invested in 3 tranches over, I believe, June, July, and August of 22. The $46 million, put it into the portfolio pro rata for each investment, got whatever its allocation was. And right now that pension obligation bond money net of all fees is up 27% from the time it was invested. And that is a cumulative number.
2 years and 2 months.
2 years and 2 months ago, that money was invested. 2023, you're up 13.8%. And for 2024 at the moment, and I'll show you this in just a sec, y'all are up a little over 11%, but you can see how it's pardon me. You can see how it's shaken out. The first quarter, you were up 4.5%, second quarter effectively flat, and up 6.4% in the third quarter. So y'all had a fantastic third quarter. Net cash flows over that 13.75-year period. So all the money that's been contributed to the pension plan, including the $46 million, minus all of the money that's come out of the pension plan via benefits, comes to a net positive cash flow of $19.6 million here. The 13.75 year, so 13 and 3/4 year annualized growth rate of a little over 5%. This was close to 7% before 2022. But it put a torpedo in the side of the performance. Your long-term portfolio target is 7.5%. Your inflation assumption, is 3%. So our real goal is 4.5%. And so this 2.36, we actually had it right at 4.5% before 2022. But you can see how a negative return on the nominal side minus this large inflation number exacerbated what we would refer to as the actuarial return of the pension fund, which is here's the torpedo right here, this negative 20.54%. And when you're looking for an average of just 4.5%, you can imagine what kind of damage a negative 20.5 does to your long-term growth. But we are confident that this will return, and we can see that in 23 you're up on an actuarial basis 10% after inflation, and you can also see that inflation has been tamed quite a bit in 2024. So with an 11% or 12% annual rate of return for 2024, it wouldn't surprise us to see a 9% return here for 2024, thus enhancing the long-term rate of return. This is your executive summary. So at the top, you'll see the total asset value, a balanced peer group as you're basically a 65-35, a 5-year return and rank. So your 5-year return is 7.2%. And that takes you back to the Q3 of 2019. The 3-year return, 3.64%, and the 50th percentile, so right about average for that time cut. And then above average in the 43rd percentile, ranking up 21.18% net of all of your fees for the 1-year period, September 30 of 23 through September 30 of 24. So y'all have had a great year. Looking at the individual funds, we spend most of our time on the 3-year number, particularly because the 1-year number just seems statistically it jumps around quite a bit. And you'll have all sorts of managers that will make an investment in the 1 year that may not make them look very smart, but they're buying low and, of course, selling high. So their long-term record is what we wind up focusing on more or less. So on the 3-year basis, the Loomis Sales Growth Fund, that 8th means they're outperforming 92% of 632 managers on a risk-adjusted basis. Vanguard Equity Income, 34th. Clearbridge, 53rd. Fidelity Low Price, 28th. Hood River, 3rd. MFS New Discovery, 65th. MFS International, 7th. Fidelity Emerging Markets, 12th. And you can see what I mean on the 1 year. You see some of these numbers, 71st, 75th, 92nd. So if we were to hire and fire on the 1 year numbers, I don't think we'd ever stop hiring or firing people. But 22nd for BlackRock High Yield, that's your high yield bond fund, top quartile. And then MetWest Floating Rate, top quartile as well. Your floating rate position. I know that over the last several quarters, I've discussed probably ad nauseum reorienting the floating rate position based on the interest rates and how they are moving. Well, at this moment, we're not recommending making any changes amongst the fixed income composite simply because we haven't seen the bond market really settle down and achieve what they call their terminal rate, which we think is closer to about 3.5%. And we're right now roughly at about 4.25. So we've still got some room to run on that. Looking at the individual funds that are not risk adjusted, but are return and rank, Vanguard Large Cap Index, that's your large core, 41st. Vanguard Mid Cap, top quartile. But you see on the 1 year how this has begun to normalize, particularly with the small cap. 2022 affected index funds far more negatively than it did actively managed funds. And you can see that proof right here where you see that everything's fine, you're above average for the core, and then all of a sudden 2022 comes along, wipes out the index fund, and then you're back to top quartile over the short term. Same thing with mid-core, same thing with small core and mid-core. You see that 29th and 27th on the 1 year here and here. And then the real estate is an index fund, top decile 7th, Guggenheim 50th, PGIM 28th and 12th. These are two very complementary core bond managers that have excellent long-term records, but they achieve it in different ways, making them very complementary to one another. And then JP Morgan Global Bond Fund 3rd, Millennium, your hedge fund 3rd, 1st, and 18th. Also, if anyone's wondering if you own cryptocurrency or have any exposure to Bitcoin, it's hiding inside your Millennium hedge fund based on their most recent filing over the summer. Blackstone Bread's a real estate debt. Here you have returns here, Cohesive Capital, private equity, which are just smidgens as they are winding down, but nevertheless, negative 5% on the PIMCO Bravo, 14, and then up 12% on the 1 year. And then the student housing, 16.5, 24, and then 20. Also on Campus Clarion, you only have two assets left in Campus Clarion. One is located in, I believe, Ohio, and the other is located at Florida State University. And both of them have bids that have been made on those properties. They are currently under contract and should close by the end of the year. So we would imagine Campus Clarion would be closing out its fund in early 2025, perhaps mid 25, once those transactions settle and they're able to pay their investors. The total fund this is your total net return. So as I mentioned earlier, you're up 11.33% year to date. You're welcome to go back, 10 years. You've got about 73 basis points worth of cost, investment related expenses inside the fund. So you're 5.18 versus a 5.88 on your benchmark here on the 10-year, 6.9 versus 6.12, 7.2 versus 6.8. So some great outperformance, 3.6 versus 3.48, more great outperformance, 21.18 versus 21.12. And again, this is a gross number and this is a net number. And you're 11.33 versus your benchmark up 10.57%. So the pension fund is just running beautifully from an investment standpoint. We're very, very pleased. And then here you'll see the return rank of the pension fund across the 10-year, 7-year. How long have we been working for y'all?
2017, I believe.
So 7 years. So right on the 7-year cut is when we were hired, and you're 26th, 38th, 50th, 42nd, and 45th. For those time cuts. And so from an investment standpoint, we are very, very pleased with the portfolio. Now I'd like to switch gears, if I may, and discuss something we would like to add to the portfolio. Currently, you have this, where's the best place to show this?
Fidelity.
Yes. So this is on the executive summary here. Actually, let me go back to this one. I'm telling you, I have learned more from Scott Shellhorse. Amazing. All right. Let's go back one page. All right, the Fidelity Emerging Markets Fund, you have a 5% target. Fidelity's been a great fund for y'all. You can see that it's got great long-term performance. However, it has stumbled a bit on the short term. That's not so much our concern. What we'd like to do is, in plain English, sell half of the Fidelity Emerging Markets Fund and invest it into another emerging markets fund. And the reason for this is that Fidelity Emerging Markets Fund is basically a mid-cap emerging markets fund, which is, again, has done great for y'all. We'd like to diversify it a little bit and add a large cap emerging markets fund to it as well. So we would simply be selling. At the cut of September 30, it was roughly $4.8 million. We'd be selling $2.4 million approximately and reallocating it to the Goldman Sachs Emerging Markets Fund. It's very simply put, it's a very good large cap emerging markets fund. It's got a similar country allocation. It's not from an allocation standpoint, it's not terribly different from Fidelity. However, from a cap size standpoint, it is quite different. And we think it would be a great diversifier amongst the emerging markets. This report here, let me go to full screen. This report here, let me blow this up a touch. This is both your this is your current manager, Fidelity Advisor Emerging Markets Fund. This is the return rank. And you can see how great it's done for you. And then it's slipped over this. And that's not so much a problem for the fund itself yet, but it's something we would like to diversify into a large cap as well as mid cap and have both slots there. So this is how they both rank on return. You can see they're both quite good over the 3-year period, and only Fidelity of the two has really slipped. Those are the peers. This is the number of peers as well in this peer groups. I find that interesting as well, 775. The alpha production, you can see that the Fidelity has had some negative alpha production over this year to date, which would be another way of diversifying Fidelity, is include Goldman. The alpha rank, you can see, which you just saw on the executive summary as well. But the alpha rank of both managers on that 3-year, again, they're both quite good, but we'd like to diversify the Fidelity with the Goldman. And that, I feel like I went through that a little quickly today, Mr. Chairman, but are there any questions or anything you'd like me to go further in depth on?
What is the fee structure of the Goldman Sachs in comparison to the Fidelity?
Sure, they're very, very similar. The Fidelity, I believe, is low 90s, and Fidelity is 1.06. So, and for emerging market funds, that's about normal because consider the type of research you'd have to do on analyzing, companies in Brazil, Russia, India, China, and all emerging market funds that are worth their salt charge a pretty hefty fee, including your Fidelity.
So Fidelity was lower? I mean, Fidelity was higher on the fees, I think, than what you said?
No, sir. Goldman's a little higher.
Okay. And then what's the exposure difference to like China?
They're almost identical.
It's just cap size.
They're almost identical. The primary difference between them, John, is their cap size. Basically, Goldman is large cap and Fidelity is more mid cap.
Is there a reason why you prefer large cap? It seems like selling low kind of deal.
Well, I'm sorry.
It kind of seems like it's selling low because mid cap has performed less, which is more sensitive to interest rates than large cap. So it seems like you're selling one for another one. Go ahead.
That is accurate only over the short term. Over the long term, they both do quite well. And the Fidelity is certainly not a loss as far as the pension fund is concerned.
We're not selling at a loss.
We're certainly not selling at a loss. That's a great question, though. That's an excellent question, and
I don't know
I'm
if it's at a
finding.
loss. I'm just saying on the performance side, in the recent 1 year, it's down
Oh,
considerably
what?
more than. Can you hear me?
Yes, sir. And I misspoke. I just realized I misspoke, John. I apologize. The Fidelity Emerging Markets Fund is 1.12% fees, and Goldman is 1.06.
Yeah, so they're very close. Yeah.
They're pretty
Yeah.
close. But yes, sir. I just want to make that perfectly correct. Before I-
Over the long term, do you feel better about large cap over mid cap and emerging market?
Oh, no, sir. I would just like to balance them out to where we're fully diversified within that asset space. We don't necessarily have a preference. We would just like to diversify the emerging markets where we're not so tied to one portion of the cap scale.
All right, and how long is the fund manager, the main one for Fidelity, compared to the Goldman?
In our screens, we screen for, let me see.
Looking for team.
Yes, sir.
Okay.
The
2014 for Fidelity,
so 10 years for Fidelity.
and then for
The
Goldman.
team has been there 10 years, and I'm about to get you the Goldman numbers. But during our screens, that's one of our screens, John, is to have a long-term managers in place. And the data we have is 20 years on the Goldman.
Okay.
But that's a great question.
That's all my questions on the swap on that, and anybody else can answer. And I have some questions about some other funds after that.
Oh, also, I forgot to give an update on Rastegar. I apologize. Rastegar, we received an update on Kyle. Everything is proceeding as planned as far as the construction goes, and there will be a third-party valuation, an independent third-party valuation forthcoming I believe, late spring, early summer of 25. But they sent us a recent valuation. It was up considerably, but that was not a third-party independent valuation.
What did they have?
Sir?
What did they have? That's
Oh,
about
I
it.
believe
30 and 40%.
it was up about 30 or 40% from the investment.
And when was the investment made?
This was estimation.
I don't want to put too much into that because it is an estimation by the administrator, not a third party. So I wouldn't want to get too tied up in those numbers that they were, again, estimating.
But that's cumulative and from the investment period. When was it invested?
It was invested in 2021.
No.
Or hold on,
I think it's about 2 years.
John. I can have that for you in 2 seconds. Give me 2 seconds. Yeah, as I mentioned about my birthday, these years are clicking by. That investment was made. That investment was made in September of, no, pardon me, the end of 2022.
Yeah.
So it would be right at almost 2 years.
Thank you.
Yes, sir. And
He had a few more questions.
yes, sir. Yes, sir. John, you had some other questions on some other investments?
Yeah, I just want to talk about, and I'm going to go through them. Y'all can mark them. Clearbridge, MFS, New Discovery, and PGIM, total return.
All right. Let me pull these up. Let me share my screen again to where I can. Sure. All right. Let me pull these up. All right.
Are any of these on your watch?
Let me blow this up just a little. Oh, I'm sorry. Hold on. Full screen mode. I'm forgetting my lessons. All right. Now. All right. Okay, John, let's take them one at a time. You mentioned Clearbridge.
Yes.
All right. No, sir. ClearBridge is not currently on the watch list. Their performance doesn't really warrant their being on the watch list just yet.
Okay, I was just looking at their 3-year, and there's a
Oh, yes, sir.
considerable
And,
shift.
and as a reminder, the watch list really comes into play on the 3-year when they hit the let's say the 70th percentile on the 3-year, they have really gotten themselves on the watch list. And if they breach the 75th, 80th, then termination is very much considered. And the reason for that, again, is simply because they've gotten themselves, and the manager gets themselves into a statistical hole they're not likely to get out of. Without just a string of incredible performance, which is not likely at that point. There's probably been qualitative change within the management structure of the firm. Also, they will do things that we did not sign up for, so to speak, meaning they'll try to get themselves out of that hole by investing in a way that might not even be appropriate for the plan. So we want to avoid that. And third, and maybe most important, is as the fiduciaries to the plan, the opportunity cost of holding on to a manager that's in the 80th percentile on the 3-year number is just, it gets too large. And so it's not that we would ever wait 3 years to terminate a manager, but that 3-year number gives us our best sense of the magnitude of the recent underperformance. Therefore, we don't chase performance and hire and fire on too short-term data. But no, that's actually one of my favorite questions I get, John. I wish everybody asked that more
They've come
often.
roaring back like they're.
And ClearBridge they were down a bit more last quarter, and they have come just screaming back in that 10th percentile ranking. And then I believe it was MFS was the next one.
Yes.
MFS nearly found itself on the watch list last quarter, and they've been sort of drifting higher. But what I would say about MFS is, for number one, you've still got positive alpha across the board. It's average on the 5-year, a little below average on the 3-year, and above average on the 1-year. And also, with what has just happened, Charles and I have been talking a lot about this, about some other clients that do have managers that are very much on watch lists and are on the fence of being terminated, is that just over these last 3 weeks since the election, the market's attitude about the future vis-a-vis regulation, vis-a-vis taxes, profitability, onshoring, and the like, and tariffs and all this has now been baked into the market, and that's not coming through this report at all. And so we've actually put off some terminations because the last thing we'd want to do is terminate a manager that's in recovery mode. And so we've actually held off a bit on some terminations because the dynamics of the stock market have changed so drastically, so recently. And it's those numbers, that data is not encapsulated in our current reports, that we've postponed some terminations just to see what the manager did. Because again, the last thing we want to do is terminate a great manager that's doing something a little out of favor on the short term.
Not with them.
But yes, sir. And then the other one.
Hold on, Will, I'm sorry.
Oh, sure, go ahead.
On the New Discovery Fund, is that the one that we recently did a trade for a few quarters back?
No, sir. I believe you're
okay.
thinking of MFS International Equity Fund.
Okay. And then,
Yeah, MFS International Equity Fund replaced Vanguard International Growth and Value.
Okay.
And
then
that was, I believe, 3 or 4 quarters ago.
on the performance, I mean, if you're looking at, I understand there's positive alpha, but if you're looking at compared to Hood River, which looks like a fantastic pick by y'all, and then also even just the Vanguard Russell 2000, I mean, it's drastically underperforming in every
You're absolutely right. Value investments by and large have struggled much more than growth over the last year and a half. There's no doubt about that. In fact, you can see that also in your large cap value here, that 71st. I don't know if you remember the last couple of reports, but the last couple of reports we brought, Vanguard Equity Income was in the 60th on the 3-year. I mean, they look terrible on the 1 year and the 3 year. And then again, as managers do, they came roaring back. But the only reason why you see the 75th on the large growth, it's not a value issue. It's because this is a diversified large growth fund, and all the large growth funds that have dominated that peer group have been very heavy in technology. And long term, we think technology is a great place for growth, but we'd rather have something a little more diversified for a public pension fund. And that's why you see that bit of underperformance on the large growth. But yes, that's a great observation. Value investments by and large have trailed growth investments. And you're right, Hood River is just screaming along. And it is at the moment almost anomalous.
Yeah.
But small cap value has absolutely struggled, and that it's been there quite a while.
Okay, awesome. And then, yeah, just real quick on the PGIM total.
Sure. Not a problem. So PGIM and Guggenheim are your two total return funds, and they are highly complementary of one another. And they actually Guggenheim has suffered a bit more over 2022 than PGIM did. But certainly over the 1 year, they're both top quartile. In fact, PGIM is outperforming 88% of its peers on the 1 year basis. And if you just think about, I'd point out that these are returns, not alpha. So two complementary bond funds that have each produced over 13% in a bond portfolio from September 30 of 23 through September 30 of 24 is really fantastic.
Awesome. I appreciate it. Thanks, Will.
Of course. Yeah, John. Thank you. Thank you for the question. I love questions.
Do we have any other questions? Nope. So if I understand correctly, Will, your one recommendation to the board is to diversify the Fidelity Emerging Markets Fund and basically split it in half and invest the half of those sales in the Goldman Sachs Emerging Market Fund?
That's correct. Yes, sir.
All right. With that being said, we'll move on to our action items, which is action item A, review and motion regarding the recommendation of trades for the third quarter pension performance presentation.
I move to approve the purchase of Goldman Sachs Emerging Markets Fund.
All right.
Second.
Got a motion and a second to approve the recommended trade of Fidelity Emerging Markets Fund and diversifying it into 50% Goldman Sachs Emerging Market Fund. Is there any discussion? If not, all in favor say aye. Aye. Anyone opposed? Motion carries. Did you get that, Will?
Yes, sir. Thank you very much, Mr. Chairman. If you don't mind, we're going to duck out for another fire pension meeting.
Thank you, sir. Have a good day.
Yes, sir. Thank you very much. Y'all let us know if you need us for anything.
Yes, sir. All right, moving on. Action item B, review and motion regarding the reconciliation for the month of October 2024 for Moody checking account, Moody disbursement account, and Morgan Stanley Smith Barney Omnibus.
Pretty quiet.
Was Alec Tipton last month?
I believe so, yes.
Thank you. I move to approve the reconciliations.
Second.
We have a motion and a second to approve action item B, the reconciliation for the month of October 2024. Is there any discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. Action item C, review and motion regarding the internal financial statements for October 2024.
question on that $100 million rule, since we're looking at this. So
ma'am.
if we're close to it, and then we gotta wait till May for some of our valuations, do we just not do it until we know that we're at 100 million? Or maybe we'll be confidently at 100 million, and then we'll go ahead and play by the $100 million rules?
I mean, it states your close of year number, so I would say,
we don't know till
unless
May.
we, without a doubt, knew that we were gonna bust 100 million, we would probably wait and see what those
Okay.
final reports do say in regards to whether or not we have to meet that new standard or not.
Okay. I move to approve the financials. Second.
All right, we have a motion and second to approve the internal financial statements for October 2024. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item D, review and motion regarding the minutes of October 2024 meeting.
I move to approve.
I will second.
All right, we have a motion and a second to approve the minutes of the October 2024 meeting. Do we have any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item E, F, and G, review and motion for the retirement and drop of Bert Scott III, refund of contributions for Romeo Parker, and rollover of contributions for Graham Wolf. I'll let y'all evaluate those, but I will make the motion to approve all three as I did do the check of those numbers on the original.
I'll second.
All right. We have a review, or we have a motion and a second to approve the retirement and drop, refund of contributions, and rollover contributions in action items E, F, and G. Do we have any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Review and motion regarding the expense report for the TELFRA 2024 Summer Conference in Irving, Texas, held October 6th through 8th.
Great conference, by the way.
Thank you.
Yes.
You did a good job.
I got a lot out of that one too.
I'll make the motion to approve since I wasn't in attendance.
Second. I'll second it because I didn't use my card.
We have a motion and a second to approve the expense report for the TELFRA 2024 Summer Conference. Any discussion?
The only thing on,
Yeah.
hold on a second. Sorry, I was looking at. Never mind. It's on there. I appreciate it.
If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Moves on to our discussion items. Discussion of upcoming retirements.
I mean, they're all up in the air.
Yeah, I'm not aware of any.
Nothing pending in the next month
Yeah,
anyways
yeah.
that I'm aware of.
My understanding also. All right. Our next regular scheduled board meeting is December 17th at 8:30 a.m. It'll be back at the pension office. Is that date a conflict for anyone?
Nope, it's good for me.
Don't know why it would be for me, but I'll look. Oh, good. If not, motion to adjourn?
Make
Second.
motion, second.
Second. All in favor, say aye.
Aye.
Aye. Thank you. Meeting's closed.